Hello, everyone. Good afternoon. If you are joining us for the first time, I want to welcome you to the Wealthologist Live. And if you happen to have been with us before, as many of you have, we're just happy to have you back. We've got a great show today. I'm Chris Hobart, the Wealthologist. And with me today, somebody a little bit different that you haven't seen in a while, right?
It has been a while.
Yeah, it has. Yeah. Andrew Greer is here.
Good to see everyone.
I guess every once in a while we got to let Jacob go on vacation. So Jacob's on vacation right now, and we are going to actually start having probably our senior wealth advisors back in a little bit more often because you guys have a lot of good stuff to share, and you've got a lot today, and we're doing a new format. I mean, there's a lot of stuff going on.
Studio, it's been a while since I've been here.
I know. This is all brand new for you. Now, as we're waiting for some people to come in, Andrew, I always like to share, different things that happen in my life. Why? Because, hey, why not? I tend to do fun stuff on a monthly basis every now and again. And recently, as I've done in the past, I went on what's called 29029 Everesting. And this was a challenge this time in Sun Valley, Idaho. And it's a really incredible experience where I hiked 29,029 feet of elevation. We have 36 hours to do it. That's just so you're aware, that's the equivalent of Mount Everest height. So I had to do 15 trips up this single mountain time and time again. Let me share with you some pictures here. There were 292 people that signed up to do this challenge. You can kind of see them on the side there. And what we do is we'd hike up and take a gondola back down and keep doing it. Like I said, 15 times. Of the 292 people that signed up, we had a whopping 192 actually complete the challenge. Wow. So there were about 100 people that weren't able to do it, but they still did great. I'm telling you, it was hot as could be. But this, for me, this is obviously a test of endurance, and I like this type of stuff. I'm at that age where I need something to drive me a little bit. But I also want to show my kids, Sloan and Blythe, 17, Sloan, Blythe, 11. I wanted to show them that it's possible to do hard things, and to work hard and accomplish something, because I have to train quite a bit for this. Another reason we do this is a friend of mine in the past passed away, suicide. So we support the Jones Project, which is a charity that we founded in honor of him, which is to kind of raise awareness over impact of suicide, and also with teens and kids involving suicide. But I think the main thing is this is a good reminder for all of our clients that we can all do the hard things, that even the things that are difficult when it comes to our lives, even financial planning and wealth management, there's tough stuff that we got to deal with. And this is one of the things that I look at that is kind of just an example of doing something hard because hard exists. Now, I had a client ask recently, what in the world do you do this for, Chris? What do you win for this challenge? And the thing is, it's kind of silly, Andrew, because what we win is we win the pride of this silly red hat. And you'll see them in a second. Actually, you can see them behind me right here. There's one from my first event and one from this event. But that's what we get. The reward is a red hat that you get at the very end after you finish your 15th lap. And as I'd mentioned, we had 192 people get it. This is my third hat. I'm really excited to have those. That's all right. Think we got enough?
No, it's good stuff. I mean, it's rewarding. It's therapeutic across the board. And I think the entertaining part for us, we got updates every so often, every other climb up that mountain. And each time the energy level came down a little bit, but huge accomplishment.
That's true. I do know by that last one, I was just kind of dragging. Now, I don't know if I told you yet. I haven't told any of our clients yet. I did sign up for something else as well. It's called the Trail. It's in October that I'll be training for, and it's going to be 3 marathons, trail marathons over 3 days back to back. Now, I've never run a full marathon, so I figured why not do 3 in a row over 3 days? So, hey.
Head first.
That is it, Andrew. All right, so we've got an exciting lineup for today, and we're starting a new segment that we came up with called the 3-2-1. So the 3-2-1 concept is where we're going to be discussing 3 important things that are happening in the economy. We're going to highlight 2 of our favorite portfolios, and then we're going to share one really crucial piece of information we want all of our clients to know, or a topic that we're hearing from a lot of our clients. Now, each point in the 3-2-1, as we're talking about this, Andrew, because you're going to be doing all the answering, I just get to sit here and shake my head and prompt you along, but we've got to cover each of those points in 60 seconds. So each of the economic factors, you got 60 seconds to go.
Okay.
And I might have a follow-up question. I might give you a little bit of time, but I do have my phone right here to time you and yell at you if that's the case. But when I tell you, you got to move on, buddy.
Okay.
Now, the one last thing before we get into the 3-2-1, don't forget to like and subscribe to our YouTube channel. It helps you stay updated with our latest content, and it helps you make sure that you don't ever miss an episode of The Wealthologist Live. All right, you ready?
Perfect.
Now, let me get the timer.
He's got a timer.
I've got the timer queued up, buddy. All right, 1 minute on. All right, so Andrew, we are going to start with the 3 part of the 3-2-1. So go ahead and tell me, what's the first economic point that you have for us?
Yeah, let's jump right in. So thanks for having me, and not to belabor the points, let's jump right in. So the first thing that we're going to cover and talk about is interest rates. Now, you cannot turn on the financial news networks and go 5 minutes without hearing about interest rate discussion. What is the Fed's next move? When are they cutting rates? Are they going to cut rates? By how much are they going to cut rates? Why are they going to cut rates? Really, that's been driving headlines for the past year, maybe even 2 years. And what's interesting about this discussion, if we go back to January 1st, if we were having this conversation today, if we were all having this conversation today, I would tell all of you that we would probably experience 5 to 7 rate cuts this year. Fast forward to today, we haven't experienced any. Actually, last week, the Fed came out and, to no one's surprise, announced once again that they are not going to change rates. And coincidentally, next month, July, represents the 1-year anniversary from the Fed's last move, which was an increase back in July of 2023. So just interesting information there. But as we look forward, it does appear as though we are still in store for potentially 1, maybe 2 rate cuts as this year closes out.
Did anyone else hear that timer go off? Andrew,
was that 60 seconds?
That was 60 seconds. I told you got to keep it tight. All right,
Okay.
So I'm going to ask you a couple of questions because
Sure.
I do know that there's more to cover. I mean, there is talk that we're looking at a rate hike, potential, or not a rate
cut.
hike, a rate cut.
Right.
Me personally, I don't think it's going to happen. Different schools of thought, but I
Sure.
know that there's this fine line where the Fed wants to be really careful around election timeframes and not be accused of doing anything to help or hurt anybody. Fair enough to say?
Sure. Yeah, no, absolutely. And I think what we have to understand is it's really not a timing decision. And I think if you're taking anything from this conversation, it's not a matter of when the Fed is going to cut rates. The question is why. Why are they cutting rates? And there's really 2 potential scenarios where the Fed would be prompted to cut rates. Number one, which is the scary one, would be a Fed cutting rates because they believe that we're headed towards a recession. Generally speaking, we view that as a bad thing for equity markets, the stock market in general. Scenario number 2 would be rate cuts because we've finally got inflation under control. More on that to come in just 1 second. That is generally seen, rate cuts for that purpose is generally seen as a positive thing for both the stock market and bond market.
All right. Well, that's I think that's great. Now, I think you kind of led into what I think your next point's going to be.
Yeah.
So I'm going to go ahead and put 60 seconds back on the clock.
Yep.
Now you know how quick that goes. So
That
be
goes
careful,
fast.
buddy. And talk with us about that next economic point that's important.
Sure. Yeah, inflation. Inflation has been the tail wagging all dogs for the past couple of years. You can't really have a conversation about interest rates without mentioning inflation, and vice versa for that matter. Now, while we've come off of the peaks of inflation from last year, inflation has still shown persistent and stubborn trends, and that's largely anticipated due to seasonal adjustments. Now, the May CPI report did indicate that inflation was up 3.3% year over year. That was actually an improvement based upon where economists thought things were going to come in. They expected things to come in at about 3.4%. So that is a good thing. But as we move forward, inflation is expected to diminish as we get into the later stages of the summer, maybe early fall. But the concern is if inflation worsens, it could preclude any possibility of rate cuts.
Hey, good job. You saved. You made up for that for going over there. So, kind of a follow up question. It's interesting because oftentimes we hear from clients who are like, "Boy, we hear that inflation's slowing down, but it doesn't feel that way."
Yeah.
And I think the reason it doesn't feel that way is because inflation still happened. It's already been baked in, right? The inflation occurred. It's not like the inflation that we're having right now because it's slowed down makes the other stuff better.
Cheaper. Right.
It just means that instead of being at, double digits of inflation, now we're at lower single digits, but it's still on top of.
Yeah, I think that's a common misconception out there. Okay, inflation's slowing. Oh, well, my next trip to the grocery store must be cheaper. It's not the case. And as with a family of 4, I can confirm that is not the case.
Yeah, I mean, what we're talking about there is deflation.
Right.
And deflation is where prices are actually coming down. And the reality is that's probably not very likely anytime soon. Right. All right. You've got 60 seconds on the clock, Mr. Greer, for your next one. Go ahead and tell us that last economic factor that people need to be watching now.
Yeah, well, and I know everybody's already watching and hearing about it. Let's talk about artificial intelligence, right? There's no denying the impact that AI has had on financial markets and just the end user over the past year. It's crazy to think that just in first quarter of 2023, ChatGPT was first introduced. That was our first introduction to AI, right? And Chris, go ahead and bring up this chart. It's interesting where some of these trends are. You just want to share the red hat again. There we go.
I'm just bragging.
So this is an interesting chart, and it shows us where a couple different phases or sectors within the market are experiencing growth because of AI. And what we're comparing here, phase 1 is NVIDIA, or really chip makers in general. And you probably don't need to look at the legend to determine which one of these lines represents NVIDIA. And if I would venture to guess that a lot of people listening today 3-4 years ago had never heard of NVIDIA. But here we are today. Just last week, it overtook Microsoft as the most valuable company in the world. And, right out of the gates, it is the benefactor. And the semiconductor space is the benefactor of this AI movement that we're experiencing right now. And we do believe that this trend is going to continue. We do think that it's going to broaden out. We think that it's going to affect more and larger parts of the stock market. And that's kind of being illustrated here in phase 2, phase 3, and phase 4. Think of this as kind of the trickle down effect. Think of this as growth broadening out. But, with phase 2 companies, we're talking about companies involved in the build out of AI, companies like IBM, Microsoft, Amazon Web Services, companies that are that help organizations adopt and use technology, AI technology. Phase 3, companies with business models that can incorporate AI into product offerings. I think of Google as a test. Go ahead and open up a new search bar, Google something, anything, and the first hit result is going to be an AI-enabled search result. Just fascinating stuff there. And then finally, phase 4, these are companies in labor-intensive industries that can really harness AI to improve productivity. Think of healthcare, manufacturing. A lot of auto companies are already involved in this. So big picture, we still think AI has some legs to run on. We just think that it's going to impact different sectors and segments of the market over time.
All right. I gave you a little bit extra time because we have heard a lot from a lot of our clients around that, and I thought giving you a bit extra time on that would be a great thing.
Thank you.
It is interesting because we are starting to see more and more usage of AI, and even internally here, we're continuously looking for ways to create that efficiency inside of our systems here. And it's just amazing to see the power that AI has. Obviously there's the goofy things that we can be doing with AI, which are fun. The crazy pictures or the poems or stuff like that, or even writing a bedtime story for your kids. But there are a lot of efficiencies that can be built into systems that naturally are happening that just, it's almost like oil in an engine. It just makes the process a little bit easier.
Yeah.
And for that, it's interesting. But obviously, there's got to be some level of regulation on this. In our industry in particular, there's a lot of regulation to make sure that the privacy is protected. So, we've had a lot of clients ask, hey, how can you use this with X, Y, or Z? Right now, the SEC is really, really saying, hey, we got to make sure we understand this before it's used in too impactful of a way for folks in the investment world.
It's going to be interesting to see where this all goes.
Yeah, it will.
No doubt.
All right. So with all of this going on, the potential for rate cuts, which I'm going to say, inflation, trends towards AI, clients oftentimes ask, how is that impacting my portfolio? What are you guys doing about that? This is where Jacob really kind of geeks out and has a lot of fun. But Andrew, and you're talking to clients all the time about this stuff. All the different portfolio options we have, what the different drivers are. Same rules as before, Andrew. I'm going to give you 60 seconds for each, and this time it's for real. But I want you to talk about 2 different portfolios that we work with that are really either timely or important right now for clients to consider.
Okay, perfect. First one that I'll cover, we'll call this direct indexing. So this is more of a tax play than anything. And specifically, this is going to be geared towards clients or investors that have sizable non-qualified investment accounts.
Keep going.
Keep going. Does that take time out of it for me?
Nope.
So what we're not talking about are IRA accounts. We're not talking about Roth accounts. We're talking about cash investment accounts, where, think of it this way. We'll use NVIDIA as our example. If you invested money in NVIDIA 5 years ago, that stock has gone through the roof for you. Now, if you were to sell that position, then you're going to be realizing a capital gain and the taxes that come from that. So direct indexing allows us to invest in a manner where we are investing and tracking kind of along a benchmark, let's say the S&P 500. And by doing this, what we're utilizing is a combination of anywhere between 50 to as many as 200 different stocks to represent that index that we're tracking. So rather than buying a fund that theoretically gives us exposure to all of those companies, we're buying all those individual stocks outright. And over the course of a year or two, we're going to have a lot of winners in those stocks, but over time, we'll also have some losers that we have the ability to sell to kind of pocket or bank losses, capital losses that give us the ability to attack some of those highly appreciated assets, NVIDIA in our example that we're using, where we can either reduce the exposure of that position or potentially increase the cost basis on that position.
You hear that when it goes off, don't you? I'm just making sure that you
Man, this is a new test.
I know we should have run through some of your talking points before, but hey,
It's all right.
that makes it more fun. I'm giving you a little bit of leeway. All right, portfolio number 2, and real quick, I do like that direct indexing because again, it allows us to do what we do so well at the company, which is really be focused on the tax and tax efficiency portion of managing portfolio. Again, why I stopped you before, you had said non-qualified. I just want to make sure everyone understands this type of portfolio can be used inside of an IRA, but it is really meant to be used outside of an IRA in a non-retirement account because that's where it really has legs.
Yeah, I mean, if you own the NVIDIA position in an IRA and sold it,
who cares?
Yeah,
No
tax consequences.
You'll have taxes on the back end when you
take it out,
and we'll talk about that in a bit.
Right.
All right, what's your second portfolio, and go?
Yeah, so second portfolio is going to be unconstrained equity. So this is a little bit different than a majority of our strategies where we're looking to diversify and blend risk and allocation and really not over concentrate into any one sector or even any one individual stock. This whole AI craze has really proven one thing. When you look at where the growth is coming in the market, it's very evident that growth is coming from a very small segment of the market. And that trend has the ability to continue. So this unconstrained equity strategy allows us to identify anywhere between 15 to 30 individual stocks that are focused on growth that give us the ability to hopefully over time outperform any of these benchmarks that we're looking at, S&P 500, NASDAQ, things like that. It's proven very well. Again, no promise for future growth potential, but it does allow us to take a segment or a portion of the portfolio and maybe take a little bit higher degree of risk and give a little bit higher concentration in stocks that you're not going to have the same concentration with fund investing.
Mm-hmm. I like this portfolio just because it, again, it allows us something that people ask all the time is with standard portfolios, NVIDIA has really driven the S&P 500. I mean, it's it made up for, I think, 40% of the return of the S&P 500.
44,
yeah, I mean, it's insane.
Yeah.
And it's kind of how the S&P 500 is built. The good news is that's great, but the bad news is that's also overweighting a lot in one area.
Yeah.
This portfolio is a more aggressive built portfolio. It's not for everybody, but it is something that allows a bit of that weighting based upon conviction, which is kind of a unique play. So it allows a lot more play as opposed to in the management of that, as opposed to what we see with different types of portfolios.
Yeah.
And it's, like you said, 15 to 30 individual stocks. I like seeing individual stocks in my portfolio. It's just it helps me understand a little bit more what's going on. But again, not for everybody.
Not for everyone. Someone that might have a little bit higher appetite for risk and volatility, and also something that would probably be better suited in a retirement account. Yep. IRA, Roth account, just because it is a more actively managed, actively traded account. So,
all right. We've done 3. We've done 2 now for the 1. Andrew, the one thing is going to be the one, I guess, big topic that you're either hearing from clients right now or the one thing that you need all clients to hear, understand, and know is important that we need to deal with.
Yeah.
You ready?
I'm ready.
60 seconds on the clock and go.
Well, I would be remiss if I did not come on the Wealthologist and at least mention taxes. So that's where I'm going to go with this. It is very clear that our nation has spending problems, right? You look at the national debt, which is what, $37 trillion now?
I don't even count anymore.
You kind of lost track at this point. Regardless, we've got a spending problem. It's not a left or a right problem. It's a problem at its core. And we do firmly believe that one of the ways to solve those issues is to raise taxes. And that is something that we know starting in 2026, our current tax laws are going to sunset back to the way that things were done prior to 2018. And for most Americans, that means tax increases. So really, we see these next 2 years, 24 and 25, as very opportunistic to do some creative tax planning, whether it be Roth conversions, direct indexing, loss harvesting, qualified charitable deductions, gift stacking, donor advised funds. I'm probably leaving out 3 or 4 or 5, but do not allow this opportunity to pass you up. If these are things that you're not talking with your advisor about, let's go ahead and schedule some time, have those discussions, and have a plan to address these next 2 years that are opportunistic.
And to that point, Andrew, I think it's important because sometimes, politically right now, there's some folks that are saying, hey, I think in the next 2 year or the next year, we're going to see a regime change up in Washington. And, if Trump gets in, taxes are going to be going one way. Here's the reality. I don't know who's going to win. I don't like to show any political cards one way or another, but when I look at this, we have to plan for from a tax standpoint, we have to plan for what we'd consider the worst. And the worst reality right now is that taxes stay the same. I mean, good, bad, or indifferent. That's the worst thing that can happen. And they sunset at the end of 2025, which means we have a tax increase really for everybody. If tax laws change, we just have more time. And that's from a tax perspective, that's a good thing to have more time, but we are not guaranteed that time right now. And since we're not guaranteed that time, the next 2 years are very, very important when it comes to tax planning. Man, you gave a list of about 5, 6, 7 different things people can be doing taxes. There are a couple more we can throw in there, but man, at the end of the day, we got a year and a half to make some significant changes. And regardless of where taxes go in the next few years, we have a long-term tax burden that somebody's going to have to shoulder. And if you've been putting money into IRAs and 401ks, that money is taxed later at whatever the future tax rate is. If we think that tax rate might be higher, then it might be worth having that conversation about how to undo that.
And even capital gains on your NVIDIA stock as well. Held in a non-IRA account. So huge changes proposed across the board.
Well, Andrew, I appreciate your insight and thank you for playing my little 3-2-1 game. It's a little bit different. Now, as everyone knows, one segment we always like to include in these events is something we like to call Hey Hobart. And this is where we take your questions and we provide answers to them. If you have a question that you'd like answered, you can send them to hello@hobartwealth.com and we just might feature it on one of these events. Today's question kind of goes hand in hand with some of what we've been talking about. And it's since we're halfway through 2024, what should investors keep an eye out for as we head back into the second half of 2024? And here's the thing. There's a lot we got to be keeping an eye on. You've already touched on a lot of that, but a few things that I would say that are important to look at, some big economic indicators, keeping things on an eye on GDP growth, on those unemployment numbers, as well as inflation trends. These metrics are going to give you some insights into the overall health of the economy, as well as some potential market movements. Also, again, you've touched on this, Federal Reserve policies. Staying updated on any changes or potential changes the Fed might be pushing through on monetary policies, things like interest rate adjustments and quantitative easing measures. These types of policies can be a significant impacts to the market, to liquidity, and investment returns. Another big one that you got to keep your eyes out for right now would be geopolitical events. With what's going on in Ukraine, with what's going on in Israel, that all of this can then lead to international trade negotiations, political elections, global conflicts. All of these can create different types of market volatility that can have different impact on investment portfolios. And also, let's just take a look at things like sector-specific trends. And that's when you might be looking at specific trends that are going on in the market that develop in specific sectors that might give us different opportunities or risks. And that kind of goes along with that unconstrained portfolio. Mm-hmm. That's one of those things where it's really looking for those benefits. So, if there's advancements in technology or healthcare or renewable energy, that can drive growth in some of these sectors. Now, just as an aside, compliance always wants me to say this. Remember, it's always a good idea that you consult with a financial advisor just to get that professional advice tailored to your specific situation, because nothing we've talked about today is a recommendation, but it's about making sure you're educated and up to date with everything. Obviously, staying informed and getting expert guidance can help you make the best decisions for your portfolio, and we're always here to help and happy to help. But hey, guess what, Andrew? That's a wrap. I tell you, that
fun.
went quick, didn't it?
Yeah.
That's everything on our agenda today. You know, to recap a little bit, we shared some insights about different economic landscape changes, those 3 areas that you talked about. We talked about 2 of our favorite portfolios, and I like the 2 that you brought up. And we also talked about that timely question of what to watch for in 2024. And of course, we talked about taxes, which that's something you love. I mean, we all love talking about it because we can do something about it.
Right.
I think most people hate taxes because they're like, there's nothing I can do. I'm going to go ahead and tell you there's stuff you can do, and let's do something about it. Now, you may have some questions about the topics we talked about today, or maybe you've got topics about your specific financial situation. We are always here to help, always here to either lend an ear or maybe just give you some additional insight. You can always call us or email us anytime with your questions about retirement income, about investing, taxes, anything related to your financial well-being. We're here to help out. Do me a favor as well as you leave today. Don't forget to like and subscribe to our YouTube channel. It helps you stay updated with all of our latest content. It also helps us get the message out there. We think we're talking about some important things on the Wealthologist Live, and we're going to be doing the same thing next month. So make sure you tune in to hear the exciting things we'll be talking about. We appreciate you taking your time to join us today, and we will look forward to seeing you next month at the next Wealthologist Live event.